Dom Chu, let's get to today's market navigator. And does all that shines brightly indicate gold?
Well, we're gonna kind of link the last segment you guys just talked about with Pippa Stevens on the oil trade, and then link it with gold. So what we're looking at is the crude oil trade, right? Prices are slipping. Traders continue to keep an eye on those Mideast tensions. At the same time, though, gold is climbing to new highs. Our next guest says the two are actually kind of connected, and he's here to help us navigate the flow between those two commodities. So joining us now is Phillip Streible. He's the chief market strategist over at Blue Line Futures. Phil, let's talk about the oil trade. We just dove into it a bit more in depth in the last segment, but I'd like to hear your take about why you're seeing the decline in prices and whether or not that rotation, mini if you will, is going from gold into commodities elsewhere, or is it going from oil into gold?
Yeah, I believe that the sell-off in crude oil could boost gold up to new all-time highs, and there's two takeaways. It's the inflation expectations and the rotation. There's an interesting dynamic between the price of crude oil, inflation expectations, the strength of the dollar, and Fed policy. The correlation between crude oil and the dollar index is a positive 85% since the recent escalation in the Middle East. So we've seen crude oil prices, they've collapsed over the last 48 hours. You got OPEC. They cut the demand forecast for 2024 and 2025. Israel's walking back from its escalation and proposing of striking some of the oil and nuclear facilities. So how does it benefit gold? Well, over the past few weeks, we've seen this little reaction in the gold market with any kind of escalation. And now with inflation pressures relieved, the Fed can focus on the fragile labor market, take more of a dovish stance. And what we see is the dollar will begin to weaken. And with a 54% inverse correlation to the dollar, gold futures benefit. So where the rotation takes place is that money managers, they cut their bullish bets on the gold market to the lowest level in 8 weeks, and they chased inflation and they chased crude oil prices higher. Now that crude oil prices are coming off and the Fed looks like they're going to shift more dovish, they want to rotate back into those asset classes. So if you look today, you got the Russell 2000 pushing up, was up about 1%. You got bonds up over a handle, and gold futures marching higher. So the CME's Fed Watch tool shifted to a 90% chance that the Fed will cut 25 basis points in November. And we really don't believe gold prices are going to stop there. We think that central banks are going to continue to purchase as well.
All right, so then what's the trade? How do you capitalize on that? How do you kind of take that macro view and translate it into an actual event or trade?
So you look at the consolidation that we recently had in the swing low that we had. It's been about a $50 range, $26.50 on the downside, $2,700 on the upside. We believe that you buy the micro gold futures contract at $26.50. You put your stop loss just below that recent swing low, about $26.20, so you're risking $300. And we don't believe that this thing's just going to make new all-time highs. We believe that we're going to march to the end of the year on up to $28.50. So that would be a $2,000 gain and a $300 risk, giving you an optimal risk to reward.
All right, so there's the trade. A minimal amount, relatively, of risk for that kind of bigger reward if gold prices keep going higher. Phil Streible, Blue Line, thank you very much. We appreciate it.